Business owners, welcome to another live today. My name is Lunta Di La Paulo, and I am the founder of Yetu Accounting and Tax PLLC. If you don't know me or my company, we help business owners, specifically marketing agencies, achieve three key objectives. Number one, we help marketing agencies, small businesses across the nation save money on taxes. We develop tax strategies tailored specifically to the business owner and their company to help them reduce how much they pay on taxes. And we go one step further. We encourage these business owners and their companies to diversify and invest in other assets to minimize their risk. Number two, we help business owners improve their business profits. When we get on the call, we will evaluate their business, their top line, their operating cost structure to figure out ways to help them save money and increase their top line to boost their bottom line. Okay. And number three, optimize their cash flow. Essentially, in very layman terms, we help you keep more of your cash flow and less to go out. Okay. So that's a little bit about my firm and what we do. And today we're going to be talking about accounting for marketing agencies. So if you have been following us a little bit now, you know that we have been going live for a little bit now, and we have been teaching marketing agencies, small businesses across the nation about various subjects, various topics about business, taxes, succession plan, and so forth. Okay, so today I want to continue teaching you what we've been talking the last week or so about the accounting, how your accounting actually comes to be put together, what's the importance of accounting information, how you can use the accounting information. Okay, so today I'm gonna share with you a mock data point to help you get a little bit more understanding. So we're gonna be looking into the trend analysis, and we're gonna be looking at the common size analysis. Okay, and then we're gonna explore certain ratios to see what this ratio actually teach us. Okay, so that's what we're gonna be doing today. And from just like we discussed the last time, right? Business owners need to have a full grasp of their financial position, of their financial performance. If you don't know as a business owner where your company has been, it's going to be very hard for you to know where the company is going. It doesn't matter the size of your company. If you do not know how much money you're making, how much it's costing you to generate that money, and how much profit you're keeping in the business, it's going to be significantly difficult for you to actually be able to create something viable in the long run. Okay, so my job is really to help you, okay, to help you make good decisions. Okay, and accounting is a very key component in helping you as a business owner making those good decisions. Okay, so again, we're going to be talking about trend analysis, common size analysis, and ratio analysis, right? So from our last episodes, we have talked about things like what use accounting information have for you. How do you use the accounting information to make business decisions? What are the different components that make up your balance sheet, your profit and loss statement? If you haven't watched the live of these videos, okay, please go back to last week's live, and you'll see a little bit more information on that. Okay, so now I'm gonna go ahead and share my screen as customary, and then I'm gonna go ahead and and then we're gonna get things moving. Okay, so I hope you are seeing my profit, my free profit and cash flow analysis workbook. Okay, so the first thing, let me just take a step back. Okay, So what we're seeing here, let me also maximize my view here so that you can see a little bit better. Let me put that at 135. I think that's going to be better. Okay. So first of all, what do we have in front of us? First, we have the historical financial statements of the company, okay? We have the profit and loss statement, and then we're gonna also look into the balance sheet, and then we're gonna look into the cash flow statement, okay? So, and this is really the natural flow of the accounting information, right? Just look at me for a second here, okay? Your transactions goes into the accounting process, okay? Your general ledger that creates your trial balance, and then the trial balance accounts end up either on your profit and loss statement or your balance sheet. And then the information from the income statement and the balance sheet will flow into your cash flow statement, okay? So we're going to start here with our income statement, and these amounts are in thousands, okay? So we have a company that seems to be in a growth trajectory, even though it's modest, but still growing. And we have the quarterly amounts, right, to arrive at our LTM, meaning last 12 months, okay? So the revenue of this company, it's again growing slightly, and then we have the cost of revenue also following the same trajectory, right? So if our revenue is growing, we would expect the cost of revenue to follow similar pattern, right? A problem arises when the cost of revenue is not moving in the same direction as revenue, right? And then after that, we have our gross profit. We are seeing it growing. This is great news for a business owner, right? And then we have the SG&A, right? Sales and general and admin expenses, okay? So we have here from the advertising to the taxes paid, right? And other income and expenses as well. It's been kind of included there. Yeah. So from there, we have our earnings before interest, taxes, depreciation, and amortization, right? And it seems like this is a fairly profitable business, right? In the last 2 years, they literally doubled their earnings potential, right? And based on these, we can see we have good information. We are seeing revenue is growing. We're seeing cost of revenue is approximately growing, but the dollar amount only doesn't give us the full picture. Okay. So that's the reason, okay, that we often need to have, that's the reason we often need to add the famous the common size analysis, right? The common size analysis is essentially the division of every line item on my profit and loss statement, every line item divided by as a percentage of revenue. Okay. Okay, so it seems like I am not able to freeze. Okay, so it seems like there is a cell that is merged. Therefore, I am unable to. Okay, I see what's the problem. Okay, so anyways, I just wanted us to follow the same line of thinking. So revenue, it's always gonna be 100%. Okay, so revenue, it's always gonna be 100%. And please be mindful that we have 2024 estimates of what the company is expecting to perform, and then we have the projections. Okay, so you will notice that I have here the growth projections of this company based on the economic scenario that is embedded in this model. Okay, but that's a different thing that we're not going to be talking about today. But just for the sake of this illustration, we're seeing revenue, it's going to be growing modestly in the next 5 years, essentially. Okay, so compared to between 2021 and 2023, which revenue almost doubled, right? From 2024 to 2028, we're actually going to be seeing a very slow growth. Okay, and that's, I believe, that's based on the scenario that is being selected here. So if I scroll down and I look into my scenario, so I have one expansion. So 4 is when the economy is going through, right? Right at the bottom of the economic cycle there, right? So if I would change this to 1, we would see a really interesting growth trajectory, I believe. Okay, so okay, 1, okay, something is not quite pulling well here. Okay, well, anyways, so I'll take a look into this later. So here, what we are seeing, right? We have the common size analysis, which again is the division of every line item in the profit and loss statement by revenue. So everything is reflected as a percentage of revenue, essentially. Okay. Okay, there is a hand raised there. Let me see. Uh, okay. Everything again is reflected as a percentage of revenue. I'll address that question later. Okay, so we're seeing here that the cost of revenue, right, it's growing slightly, and in the projected period, we expect it to remain at 28%. So that's the expectation from 2024 to 2026. The other item that we are paying attention here is the fluctuation or movement around the operating expense items. Okay, so here, for example, my advertisement, right? We're expecting the advertising to actually start declining as a percentage of revenue. Okay, a good question would be why we're expecting advertising to Oh, sorry. In 2023, it did decline, right? So that's a good question for the management team. But then it seems like they're gonna be ramping that up in the projected period. Okay. So for a lot of marketing companies, if not all of them, one of the biggest expense is around the employees. So by the way, the employees here, right? The labor cost is included as part of the cost of revenue when I was looking into these earlier. And then we kind of broke down the the senior management costs, and then we have the employee benefit programs and expenses here as well, right? So these costs of revenue, we already know that it's going to be staying flat in the projected period, around 28% of the revenue, right? And then we are expecting the officer compensation, okay, to actually fall in the projected period here, right? We're seeing it to come from 10% in 2021 to approximately 4.5% by 2026, okay? And in terms of our in terms of our net profit, right, our net income, right, we are expecting the net income to move back up a little bit from 2024 to 2026 here. Okay, so in 2028 it was good in 2021. Per down was around 36%, but in 2022 it kind of fell sharply and then it went back up, right? So that actually could lead to very good question to the management team to understand, okay, what were the key drivers around the decline in profitability in 2022, given that revenue was going up. And by looking here, right, we can essentially see that, right, their operating expenses actually fell in 2020 in 2022 compared to 2021. But guess, look what actually went significantly up was the cost of revenue that literally jumped significantly, right? So this is a good indication, as we said earlier, that the cost of revenue is composed largely by the labor cost. So we would need to look into, okay, did the company hire more staff? Did we increase salary, maybe benefits around these people, or hiring costs or training costs, or there was such a high turnover that drove our labor costs a little bit higher. So that would actually be a really good thing to look at a little bit more, right? So as a business owner, when you are looking into this kind of information, right, that actually helps you make really good and informed decision. Um, and after we look into the common size approach, okay, I'm gonna be running here a little bit because of time. Then we can look into the trend analysis, right? So our trend analysis is to look into our, essentially to figure out whether we're growing or we are declining, essentially. Okay. So as a business owner, you need to have a good sense of where things are going, okay, on your business. Okay, if you don't know how business is performing, whether or not what trends are taking place in the company or not, okay, you're gonna have a really hard time to make really good decisions and sound decisions for your business. So first of all, we're looking here between 2021 and 2022, revenue grew by 27%, or approximately 27%. And between 2022 and 2023, it jumped by another 38%. So this is a really good growth rate, right? And then in the future year, we're seeing that growth rate to starting to decline, actually, right? So as we said earlier, right, around the cost of revenue, so there was also a significant jump, right? So in between 2021 and 2022, and then between 2022 and 2023, it actually grew less than the revenue growth, which is a good thing, right? So our gross profit margin in 2023 and 2022 and 2023, right, was actually a very, very good growth on our gross margin, excuse me. And the same thing we could also look here, right? So this we can kind of create a cutoff around, okay, what's the cutoff, what's the industry average in terms of growth rate. Okay, so we're seeing 20% here. What is, okay, these other operating expenses seems like it also jumped significantly, okay, in between 2021 and 2022. And our operating expenses, okay, between 2021 and 2022, as we saw here in the common size analysis, didn't increase much, but it did jump significantly between 2022 and 2023. Okay, so here what we are really seeing, right, is a company that in the last 2 to 3 years, okay, it had a very good growth profile, but moving forward, right, we're gonna start seeing a lot of these items to kind of stabilize. Okay, so the growth profile, it's gonna start to it's gonna start coming down, and getting essentially where in the long term we would expect this business to be performing. Okay, so this is our profit and loss statement analysis, essentially. Okay, So we saw the common size analysis, and then we saw the trend analysis. The next item that we also need to perform a similar analysis is the balance sheet. Okay, so we have the historical data, and then we have the projected data. So just from the get-go, we can see that cash is going to be jumping significantly, right? From 2023, excuse me, to 2024. And then the same kind of growth profile, we're seeing it, taking off in the foreseeable future. So, we're confident our balance sheet, balances checks out very well. We're also seeing the accounts receivables to grow modestly, right? What really worries me in these projections is how much cash is being stacked in the business, right? That deviates from historical cash balances, right? So the last 3 years, we're seeing cash at 53K, and suddenly we're close to a million, a little over, and close to 2 million, and then we're kind of continuing to grow at that over $1 million. And that, I believe, is due to the net income that the business is generating in these in the next few years, right? So it seems like these companies is getting really good at collecting cash, right? And they'll be putting a lot of their cash into money market, for instance. Okay, so that's the first thing that really stands out automatically. A lot of marketing agencies don't carry significant property and plant equipment, right? So I'm seeing a negative balance here on the projection. So that tells me there is a little bit of problem here that needs to be addressed. Asset accounts shouldn't have a negative balance, right? The other thing that I'm paying attention here, right? The payable seems to be staying a little bit flat, from the historical trends. It's not, running away from historical trends. Okay, so based on how the business will be performing, we're expecting to see a really good equity being built up in this company, right? So when we go look into the common size analysis in the balance sheet, everything is divided by total assets. Okay, so total asset is going to be 100%, and everything else will flow from there. So here's what we need to look at, right? So number one, as I mentioned earlier, right, cash flow or the cash balance, it is below 20% in the historical period. And then suddenly we're seeing a really significant jump, right, across, the estimated and projected period, right? So that, you know, we need to ask a little bit more question about why we're stacking so much, expecting to stack so much cash into the business, which is a really risky proposition. Okay, um, and as we can see here, the historical average is 15%, right? But if we did the projected average, okay, let me just run a quick formula here for cash, right? We're gonna see, okay, it's significantly higher, right? That's literally 6 to 7 times higher than the historical period. So we're gonna have really good questions to ask about situations like these. The same thing we're seeing around accounts receivable, right? So we're starting to see also account receivable deviating from historical trends. Yeah, and we're seeing the same thing here. I believe this is okay. So we're also seeing the same thing taking place in accounts payable, in debt. I'm assuming that this company debt is gonna be decreasing given the size of cash balance they will be accumulating there. right? So that's our common size analysis. And then lastly, we're gonna be having like a trend analysis to tell us whether or not whether there is growth or decline in several balance sheet accounts as well. Okay. So as predicted, right? So as we discussed already, excuse me, cash balance is growing significantly here, right? Between 2023 and 2024. And it just keeps growing, right? So our fixed asset, we know it's gonna be uh going down, right? And our debt balances, we also know it's going to be going down. But overall, we're seeing a very good equity balance, right? Being equity being built up there, right? So uh, a lot of business owners don't have these, but I believe it's very important to have. You need to have a cash flow statement, right? That really tells you the story around your cash balance, right? The ins and outs of your cash. Okay. I also mentioned that outside of the common size and trend analysis, we're also going to be looking at the ratio analysis, right? So our ratio analysis, I'm only going to discuss here the company specific metrics, right? So we have them here, and then we have the industry ratios, right? I'm not gonna discuss this today because we already have another live we have done around ratio analysis. Okay, give me just 1 second here. Let me remove some information that just keeps popping up here. Okay, maybe I'm not gonna be able to do it. Okay, let me just continue moving on. So first of all, liquidity ratio. Liquidity ratio, right, tells us essentially the story around how quick can we convert uh, our assets into cash, okay? And how much of our cash can be used to cover our liabilities, okay? So that's really the key ideas around liquidity ratios. For marketing agencies, these three, the first three, and days receivable, payable, and days payable, excuse me, are the five most important. Okay. Your current ratio is essentially when we divide current asset divided by current liabilities. Okay. So the industry benchmarks are the last this is the benchmark each year, right? The last 3 years, okay? And then this is the 3 year average. So we can look in the company and see whether or not they are doing better or below than the industry, okay? So for example, in 2022, the company had 1.6 in current ratio, but the industry had 1, meaning that the company is doing better than the industry, the average company in the industry, right? And in 2023, the company's current ratio actually is almost double of the industry. So that tells us that the company is doing very well. Quick ratio is when we get the current ratio minus, okay, things like inventory, um, prepaid expenses, right? And this is the industry. It essentially tells us how much the very quickly turnable into cash item that we can use to cover the current liability. So here, what we're seeing is the business is again better than the average company in the industry. And then the asset ratio is essentially cash divided by your current liabilities, right? So all of your short-term obligation, um, you need to have cash to cover them. So here again, the company seems to be doing fairly better than the average company, or better or equal to the average company in the industry, right? So again, we're gonna see here, great, we're seeing warning probably because of some rounding error here. Okay. And for the days receivable, right? The days receivable, the company is actually doing okay, for 2022, the company is doing better than the average company in the industry, and for 2023, the company again is doing better than the average company in the industry. So we need to actually look into why we have a warning sign here. That shouldn't be the case. But by looking into these, we can actually, let's just imagine a situation where the company, okay, this is, for example, a good example, right? Um, for 2021, the company was doing worse than an average company in the industry in terms of days payable, right? Numbers of days that it takes the company to pay its liabilities or its vendors, its obligations. So the company is definitely higher. Uh, it's taking the company much longer to pay the vendor, right? So in 2022. In 2023, we see that number coming down, the industry going up, right? So again, we need to look into the context, right? 2021, the beginning of the pandemic. 2022, the pandemic really settling, a lot of companies going out of businesses, right? So that's kind of the really good starting point. And then we go into we actually should have some solvency ratios here. Let me see if I have any below here. Okay, doesn't quite seem like I have solvency ratio. Solvency ratios are important to know because they essentially tell us how much the company actually have to pay its long-term obligations. Okay, so very important ratios to know. Interest coverage ratio, this is a good metric to also understand, which is one of the coverage ratio. It tells us how much earning potential the company has to cover its interest payments. Okay, and then we have the utilization ratio. One good utilization ratio for marketing agency would actually be, right, exactly the famous utilization ratio, how much of the capacity of the firm that is being used. Since the capacity of the firm for a marketing agency, it's going to be largely, right, the employee, the man hours available to actually bill for work. So actually we should have added, excuse me, we should have added that into our utilization ratio here. Okay, um, and then we can also look into other operating ratios for a given company, right? How much of our fixed assets is generating sales, right, and so forth. So if you have this kind of information, right? So things get a little bit easier when you put everything in a dashboard. You can, clearly see where things are moving, how things are possibly gonna be doing. Let me make these a little bit smaller so that we can have a little bit of real estate here to see, right? We can now start seeing patterns. We can start seeing issues or problems and so forth. So this is probably a good place for us to take a pause. And in next week, we're gonna start talking a little bit more about we're gonna start addressing other topics outside of purely accounting work. We're gonna talk a little bit about succession plans. We're gonna start talking about valuation, uh, identifying good buyers for your firm and so forth. So I would strongly recommend you to continue following us. If you are especially a business owner looking to sell your company in the next few weeks, you want to stay connected with us and to get some good information to help you make decisions about your firm. So again, thank you for your time tonight. I enjoyed being here with you. Please let me know if there is anything that I can do to help. Our contact information is on our Facebook, LinkedIn pages, and please reach out. And I look forward to connecting with you soon. Cheers.